Hey guys, this is Justin from breakintocre.com, and in today's video what we're going to do is talk about cap rates and why they actually don't really matter for your next real estate investment deal. Now the cap rate is undeniably one of the most widely used commercial real estate investment metrics, but at the end of the day, how important is a cap rate really? And at the end of the day, should you be using a cap rate to guide your real estate investment decisions, or should you be using a different investment metric entirely in order to value a real estate deal? That's exactly what we're going to cover in today's video. Now, if you're new here, on this channel, we talk about real estate investing careers and real estate finance and financial modeling. So if you're looking to break into the real estate investment industry for the first time, or you're looking to advance your existing real estate career, definitely make sure to hit that subscribe button and hit the notification bell to be notified every time I release a new video. Now, if you've been in real estate for any amount of time, you probably know that the cap rate is just taking the net operating income for the deal and dividing that by the purchase price of the deal. So if you're analyzing a deal with a purchase price of $10 million, and in that first year, you're expecting to get a $600,000 net operating income, then your cap rate for that deal would be 6%, meaning that you would essentially receive a 6% cash return on your investment, not taking into account any sort of debt on the property. Now this metric can seem helpful at first glance, and oftentimes it's helpful just to get a benchmark of where the valuation of a property might be. That said, the cap rate fails to take into account a lot of other really important factors in a real estate investment that are going to end up making your returns over an entire 5, 7, or 10-year hold period. So in this video, what we're going to do is break down the 5 major downfalls of just using a cap rate to value a real estate deal and what you should be using instead. So number 1 is that cap rates don't take into account debt. So given the fact that most real estate investments are leveraged, meaning that they have debt on the property, that's going to change that first year return significantly from that 6% cap rate. Also, real estate can often be a negative leverage investment, meaning that by adding debt on the property, your cash return, or that 6% cash yield, is actually going to be lower on your initial equity investment with debt than without it, especially in a high interest rate environment. In fact, what most people don't understand is that anything higher than about a 4.25% interest rate on a 6% cap rate deal is going to put you in a negative leverage situation, meaning that that cash on cash or cash flow return on your initial investment is going to be lower than 6% for anything higher than a 4.25% interest rate. Now, number 2 is cap rates don't take into account capital expenses. So especially when you're dealing with an office property or a retail property that's going to have a lot of tenant improvements and leasing commissions in order to really operate the deal and make sure that the property is leased up, the net operating income just doesn't take that into account and can't factor that in to that percentage that you're calculating. This can be especially true for smaller properties where a $100,000 or $200,000 tenant improvement allowance can really skew your numbers and hurt your deal and make that 6% cap rate turn into more like a 4% or 3% return in that first year. Now, number 3 is that cap rates don't take into account market rent growth. So many properties in coastal markets and major metropolitan cities see much lower cap rates than properties in the Midwest United States, for example, or more suburban or rural areas that may be less densely populated. So when an investor thinks that automatically a 7.5% cap rate in Cleveland is a better deal than a 4.5% cap rate in San Francisco, what they haven't taken into account is that the market rent growth and potential for market rent growth in San Francisco is significantly higher than what you'd see in a Midwest market like Cleveland. So just because you see a property at a 7.5% cap rate starting from day one, 5 years from now, that net operating income might be exactly the same in that market, whereas the property that you bought in a major metropolitan area like San Francisco is likely going to have a significantly higher net operating income at that time. Now, number 4 is that cap rates don't take into account renovation premiums or any mark-to-market lease-ups. So when looking at a deal at first glance, you may think that buying a deal at a 3% cap rate is totally insane. Well, what if I told you that the building was only 45% occupied, the in-place rents were a full 20% below market rates, the property is in a great market, and in less than a year, that 3% cap rate could go to a 7% cap rate. Would you think that deal is crazy after I told you that? So even though you may be looking at a 3% cap rate, that 3% cap rate is going to tell you nothing about the overall profitability and potential of that deal. Now finally, number 5 is that cap rates don't take into account sale value. So for example, say you buy 2 deals, each for $10 million, and you put up $5 million of equity on each deal, so you get a 50% loan on each deal. The first deal that you buy is in a property that's seeing negative net migration, so more people are moving out than are moving in. You have stagnant job growth, so not much job growth in the area, and you buy that property at a 6.5% cap rate. Sounds pretty good, especially in today's market. Then let's say you buy another $10 million property, again with $5 million of equity invested, this time in an emerging, strong market with a ton of job growth potential, and you buy that property at a 3.5% cap rate. Now on the surface, that 6.5% cap rate sounds a lot better than that 3.5% cap rate. However, let's fast forward 2 years when we sell both properties. Now because that first property was bought in a market that wasn't seeing all that much growth, you really saw very little increase in your net operating income and ultimately your valuation, and you ended up selling that deal for about $10.5 million. Now after selling commissions and any sort of other sales costs, even with your cash flow over those last 2 years, you ended up just about breaking even on the deal. Now your valuation on that second deal, however, blew through the roof. So now in 2 years, your rents have grown tremendously, your net operating income has grown even more, and you're able to sell that property for $15 million just 2 years later. Now, even after you pay off your $5 million loan, assuming you haven't paid down anything during those 2 years, at the end of the day, you doubled your initial investment, even though you bought the property at a 3.5% cap rate. So even though that 6.5% cap rate looked a little bit better on the surface than that 3.5% cap rate, at the end of the day, when you take into account sale value, the 3.5% cap rate deal would win out every time. So at this point, I hope I've convinced you that even though the cap rate can be a helpful tool, it shouldn't be the end-all be-all for figuring out what your valuation of the property should be. So that said, what is the return metric that you should actually be using to value a real estate deal? Well, that return metric is the internal rate of return, or IRR. Now, why does the IRR make the most sense to use on a real estate investment? Well, essentially the IRR takes those 5 factors that we just talked about, wraps it all up into a bow, and gives you an annualized rate of return on your investment. So this is great for investors who are not only looking at real estate as their only investment vehicle, but also trying to compare the investment to things like stocks and bonds and other private equity investment vehicles. So the IRR is just going to give you a more reliable sense of the returns of the deal overall, taking into account all of these different factors and the overall cash flows that you're going to receive on that deal. Now, if you want to learn more about the IRR, how it's calculated, or other key investment metrics that you're going to want to use in your real estate investment analysis, I'd highly recommend checking out my most popular course, the Real Estate Financial Modeling Bootcamp. In that course, you're going to get the foundational skill set that you really need to know to understand real estate finance and understand real estate financial analysis and financial modeling. So if you're looking to land a job in real estate private equity or real estate brokerage, I would definitely recommend checking out that course, and I'll link that course in the description below. So if you like this video, please let me know by hitting that like button, subscribing to the channel, and sharing this with anyone else who might find this helpful. Thanks so much for watching, and I hope to see you in the next video.